Great to
Brilliant.
have you back, Peter.
Thanks, Dan.
So, I guess we could start here in the S&Ps. I do want to go to Euro with Draghi being here. So,
Yeah.
30.23, that was a high. We've traded 61.8 back off last week's high, I think. And is the approach here that we shouldn't take out? I think it was 30.19 or so, or are you looking for 30.23, one more new high?
No, I don't. I don't think it should make a new high, to be honest.
Okay.
It looked as if the structure within this final leg for wave C. This is a zigzag, by the way, moving up from the lows we've got here down in early June. So we come up wave A. Here's a tiny retracement for B. Don't see that too often. But the very noticeable aspect to wave C is very distinctly different to wave A. We have two types of impulse waves in Elliott wave theory. We have an expanding impulse, which is what this looks like in wave A. So it's pretty vertical.
Yeah.
And you normally get an extension in the third wave. I think everybody's familiar with that idea.
Yeah, the money wave.
Exactly. And and then you get a diagonal impulse, which is this sort of like wedge-shaped thing, where you get overlap as well. And actually, we've got a shorter-term chart here. You can see a bit better. So here's wave one of the diagonal up here into mid-June, and then you get a retracement, and then you get three. And then the retracement in four sort of briefly overlaps wave one, and then you get the fifth wave. So when you count the subdivision of that sequence in 5 waves in a sort of wedge-shaped type process, it should have already been completed. So I would be very surprised if we took out 23.5.
Okay. All right. So pretty nice risk reward. No one, I talk about the VIX, and no one wants to buy insurance. A lot of complacency, but not the same type of euphoria at these highs that we had at the last high. That showing up in, some put call stuff. So it looks like we're going to have a Mueller high here. He's speaking now, a failing rally, and that's a pretty deep retracement. So if people aren't enthusiastic about risks now, they're certainly not going to be should we attain your objectives of 2,700. So it's a roadmap. This is a 4, and then after 2,700, we blow off to new highs again, Peter?
Yeah, I mean, actually, this movement down here back in December was, of course, 2018's correction, wasn't it? And that was sort of this pattern here, the longer term situation. We unfolded here into this hybrid expanding flat, I call it. And this big swing up, we've just been looking at just now is wave one of intermediate 5. So if we go back even further, we're on track to get to the 4,400 number, which was our forecast. Can you believe that was our forecasts about 5 or 7 years ago?
I thought you were crazy.
I thought I was crazy, because I mean, but the thing is,
my mother would say, in an era that you have to pay someone to hold your money in Europe, that it's turned into, it's a Yiddish word, a mashugana world. Crazy world, bro.
Yeah, it is. Well, when I speak to my mother and she gives me advice, I have to go through a medium. But anyway,
me too.
And right. And generally, they have a.
I have some clients that will be looking for me in that stage too. So, okay. So the bull market alive and well. Okay. And that's a very interesting thing. Do you have any feeling as far as how much time to complete all this? Is it going to go into the, we have Mueller talking today. Is it going to go into the election 2020 and beyond? I think you were looking for everything to kind of be okay until like 2021 or so, Peter?
Yeah, I think
equity-wise.
There's a 94-year cycle. I'm just going to pull it up. I think I've got it here. It's on the Dow. It's just... It's just come up on another screen. I'll just give it
Yeah,
across.
where we would begin the generational bear market. 23.
Yeah, yeah.
Wow.
I mean, this is 94 years between 1835 to 1929.
Okay.
Yeah.
Is
If we
that
just
Kondratiev 1.38 or
well, it's just I don't know, 94 years. I think that's probably a planetary interrelationship.
okay.
I'll have to check,
Well,
but
I don't know. This pretends to me that President Trump's going to be realisted. I just can't
I
see
would
us
think
get.
so.
I
Yeah.
just can't see us getting to 4,200 with a real progressive agenda of it. Trying to take all the money away from Wall Street
Mm.
and redistribute it. I can't see how there would be a 4,200 Dow. Do you think that this move of having Lagarde replace, and I know you're more of a technician, but I know you think about these things.
Mm.
So what does that mean to you that Lagarde is going to replace Draghi?
Well, I think that they're much out the same peapod, really. To be honest,
Okay.
there's not going to be too much change from what I can see. I mean,
Yeah.
she's
She's kind of
always
like a reorganizer. I mean, she specializes in countries going bankrupt. Maybe they need that type of person for some type of restructuring in Europe.
yeah. Well, don't forget she was the French finance minister, wasn't she, in the
Yeah,
past?
that's right. Yeah.
So she's got a sort of hopefully she's got a math degree,
Right.
but I don't think she's got sort of intense knowledge about the mechanics of monetary policies and things. I mean, obviously that means that she's going to come with her own take on the situation. But when I said she's out the same pod, I think it's mainly because she recognises that there is a need an assistance from central banks to help economies. They still go through this Keynesian sort of idea of economics where you've got to sort of flood the money.
The only person that actually understands monetary policy better than anyone at the moment is Bernie Madoff, and he's in prison.
Yeah, he got caught doing what we've been doing for
well,
decades.
you're right to say that, because in a way we're living in a Ponzi scheme. There's no doubt about it. Did you see that last week or earlier this week, the Chinese launched their Star exchange on the Shanghai Stock Exchange? And
yeah, actually, I did. I read an article in Financial Times. It was crazy.
That's right.
How the market moved.
Well, I mean, it was incredible because the initial 24 stocks that were listed, they were producing something like 155% returns from a sort of a launch on that platform. There's going to be more over time launched, but the PE ratios are huge. I mean, one company was something like 200 times its earnings. Price of 200 times its earnings. 200 times. I mean that's sort of normally bubble territory.
Yeah, that's .com territory.
I mean that's really ridiculous. So when we look down the pipe,
Pets.com. Pets.com. Do you remember?
Yeah, sure. Anything with a .com was worth $1 billion.
Yeah.
So, Peter, let me ask you this: with this happening, and I know that I want to give you credit. Part of the reason I was negative yields, that yields were going to head lower, and then I've been trying to bottom pick them a little bit here. Bonds are making new highs. I remember you talking about 202, and then you were looking for maybe some type of bounce. Will work for food. Will work for food.
couldn't resist it. Sorry. This is circa 2000, by the way.
This
is circa 2000. So this is 18 years old. So I don't know what we're going to get.
Well, I work for, I don't know. They have this new IPO, something about meat, fake meat. I don't know. It's all these IPOs. I mean, Uber, Peter, said they don't expect to be profitable ever.
Sure.
Ever. Okay, so we're going to 4,200. Is that going to be spurred by lower rates for longer and central banks. Do you think that the Fed, if we get this correction, I'm sure they're going to be cutting, if you're right about a pullback to, I think you were looking for about 26, 2,700. Fed would get aggressive down there. Don't you think that's where they use their bullets?
Yeah, I think so. I mean, it's inevitable that they're going to try and help. I mean, obviously, you've got the one hand, you've got Powell, who's very reluctant to appease Donald Trump's ambitions to try and get interest rates down to zero.
Yeah.
And so therefore you can't take him for face value. I always said that the Fed are very reactive; they're not proactive. And I've written a few articles about that in the past. And I believe that that will eventually be their undoing, because, you know, if you haven't got anything to really surprise the market under, you know, financial stress conditions, then, you know, you're not going to be able to convince people to. I mean, it was a very good exercise. Don't forget, back in the financial crisis lows in 2009. But if you're running to a dot plot scenario, which everybody can see, and the central banks are insistent upon it, and relying on the data, they see everything just as we do. The only big difference is that we, as market traders, have a bit more acumen in recognizing when trends change direction, and therefore that means that you know, we can be a bit preemptive, but the Fed can't. I tend to think that this particular chart I'm showing now is the 10-year Treasury yields. It's our current forecast, and
right. Okay.
We've tended to. I think at the beginning of last year, we could see that the markets, the yield was topping out. It was about to change direction, and it was about to lean over. And
yeah,
we had a
the
target.
last time you're on, you're also very bearish copper at the highs, and
Right.
and bullish Bitcoin near the lows. So, I mean, you're anyone just go back and play Peter's last interview with us, and some very prescient calls, Peter. Really, you know. So let me ask you something about this 170 target, because I mean, you know, that's 20 bips or so under the recent low.
Yeah.
So that's still above the historical low of 135 on the 10-year.
Yeah,
so it's
absolutely.
going to be a higher. It's going to be a higher low in rates. Is that going to signal what could be the end of this bond bull market, since we're not going to confirm and take out 135 now, and that after 170, the biggest surprise would be yields going up, yield curve steepening, while the Fed is still easing?
Absolutely. I think that's going to be exactly the scenario. And we haven't talked before this interview today. So, and our thinking are very much aligned, because I was updating some of the short end of the curve, especially the 2-year. If you look at the 2-10 spreads in dollars, you know, that's flattened out to very low areas, but that's going to steepen. That's going to start widening quite dramatically next year. Not
That's
this
going
year.
to be good for the banks, huh?
It's going to be good for the banks. The banking stocks have been hit badly in the last 2 years. They're going to start recovering. And don't forget, the stock market is a pretty good bellwether of what's coming, because we looked at the S&P a short while ago, and the bigger uptrend is still very much in play. So you're not going to see a protracted decline in the long end of the curve. This, I think, will bottom. It might exceed 170, but ultimately, I doubt if it will get too far below that, because we're defending basically this low. This is the one you referred to. We're defending that also on the 30-year as well. Let's have a look at the 30-year.
Yeah, I noticed the 30-year has a little better construction than the 10-year. That's why I thought the yield curve would steepen, is because the 30-year recently has been a little stiffer than the 10-year.
Yeah. I don't think that this is any way going to break below these lows. Certainly not. And this is obviously a forecast down to 230 this year. But in principle, you know, if you look at those aspects, then that tells us, yes, we definitely should be looking at a bottom around year end. And at least before then, stock market, this S&P drop is about 11%. I think it's about 17% actually on the NASDAQ. So that should underperform, as it did, obviously, pre-December. Last year during the October-December time.
go ahead. I'm sorry. Go ahead.
So that all sort of gives us the impression that this is going to bottom before year end. Copper's going to bottom down here. Oil's going to bottom, and then they all get the next big shove in the inflation pop. You know, this idea of an inflation pop is, you know, is something that I coined the phrase in 2010, which was basically responding to the fact that the central banks around the world, particularly the Fed, were inflating asset prices, and the typical sort of inflation pop pattern, which I'm writing about constantly, and we're just publishing in our trilogy video series. If anybody's interested, I'll tell you about it later. But the inflation pop looks a bit like this. Now, on the left-hand side, you have the financial crisis lows in 2009.
Yeah.
So things like copper, oil, emerging markets, they all went up in 2000 to this peak in 2011.
When the dollar was weakening.
That was correct. And then the dollar strength came back in, and we started to see this dip in emerging markets, commodities. That was the low in 2016. At that point, the big five-wave pattern in stock markets was about here in 2016. And then the stock markets continued to move up, and we started this run up from 2016. And this is where copper, for example, topped out in 2018.
Okay.
Yeah. And the emerging markets as well. Also, a lot of the Asian markets like Hang Seng topped out there. And we've been locked into this correction, and we're still missing a little bit of a leg to the downside. That's why copper is forecast lower into year end. The S&P is forecast lower into year end.
How about gold and silver? Have they peaked?
Well, no, I don't think they have.
One more push up, and then they catch a little bit of the downdraft of this final push up in the dollar, because, you know, I do want to get to the dollar and euro, because, you know, you had a great number that you never really came off of, was 99.20 to 102 in the Dixie. And, right, you know, we're, you know, we could be there in, you know, I don't think that would take till year end, would it?
No, well, I think the dollar index, it started to break up yesterday.
Yeah.
And you can see it here. It broke up.
You know what a friend of mine called the chart of, he's not an Elliotician. You know, it's kind of although he knows Elliott Wave. In his letter, he wrote I have a new name for the formation in the dollar index. Unintelligible. So he's been doing this 40 years. So can you be intelligent about the dollar index with all this
I'll certainly try. I mean, I have to probably zap a USB stick into my head. But actually, I've actually had quite some success in calling these movements up and down, because we could see that there was an expanding flat pattern developing from here. Can you see this March high?
We got it.
Okay, you drop down in 3 waves, you move up and break the high briefly in 3 waves. So this is a 23% extension. Then you're supposed to drop 5 waves down. Well, it gets a little bit tricky, but basically it's a diagonal ending here. I actually thought at the time that it would extend. I mean, an expanding diagonal should have extended down to this level.
Yeah, we're looking for one more dip that didn't happen.
It started to move up.
Yeah.
During this phase, this developed higher in 5 waves, and that gave us the clue.
Okay.
This was a contracting diagonal, but it finished a bit earlier. So it's technically what we call in Elliott Wave a running flat. And that's the clue. And this is 5 waves up. This is a sort of 3-wave correction of some sort. But it's breaking the high yesterday. Now, there could be a little bit of a dollar dip here, but not very much.
So I'm kind of getting the picture of the whole jigsaw puzzle now. So dollars, let me see if I have it. Dollar strength until year end, commodity pressure until year end, bond yields down until year end, and then everything flips.
Everything flips, yeah. So after that, you've got you know, the next.
I hope Santa brings me about $50K to trade this year. That'd be a perfect time, huh? Santa, how about staking me for 2020? I know it's going to happen. That'll be my letter. But
you
go
should
ahead.
be able to. Yeah, you should be able. Well, you should have made a lot of money on Bitcoin this year. So I mean,
yeah, that was a great call. You know, I got out so early. I bought a Royal Trust called GBTC at $4, and you know, I actually timed it very well during that pullback that we had into the Feb low. And got out so early. I mean, the thing went to 15, $16, and I got out with a double.
Okay.
So, well, you know, I don't know, some of these moves, you know, I want to talk to you about this, Peter.
Well,
and
I mean,
it's one, you know, it's one of the hardest things for me to do is to have a good hold. How do you hold? How do you hold
you've
your
got
position?
you've got to grind your teeth out a bit, because I had various clients saying, look, should we cash in on Bitcoin? I said, no, don't. Actually, one of the hardest things to learn in Elliott Wave is to really hold into a major long-term trend. I mean,
in any discipline.
It is. I mean, the only thing is that if you know, what I find personally from Elliott Wave is that if you distill yourself, it's all about self-examination. If you make mistakes, go back, have a good look. I mean, look, nobody likes to admit defeat or to be proven wrong. But if you do make a wrong trade, try and face the mirror and look at yourself and say, well, can I improve next time? One of the hardest things for me to learn in my career using Elliott Wave was actually to maintain yourself in amongst those bigger trends. It's one of the hardest things to do. Because there's always
because you see so much shorter when you go micro. Here's my self-talk. Well, I could take it here. You know, it's stretched. I know there's going to be a pullback. Yeah. And even if there is one, it wasn't deep enough for me to recommit, or I was focused on some other positions, and I would turn my head and it would get away from me.
I know. These are the everyday things that we have to encompass and get over. But I was absolutely steadfast during the 2016 advance, because we had this grand resynchronization lows that I showed before.
Right.
Where everything came together. You know, the stock markets dropped in 2015. They hit the low in February 16. Right. And we had that as the emerging market. I mean, the analysis in the emerging markets and commodities all bottomed at that time. We knew there was going to be a really, really long, protracted upswing from there. And I remember in my early career, there was one guy sitting on the sales desk opposite me. And he had an IQ of about 50, but the good advantage of him was the fact that when he told a client to buy it, I mean, he probably flipped a coin in the morning before he came in the office, but when he told a client to buy it, if it went against him, he just said, keep buying more. And I was astonished, you know, and frightened by this guy. You know, he scared me. But actually, a lot of the time, you know, with luck or judgment, actually he was right. And he wasn't getting swayed by, I was joking about him years later, but actually it taught me a lesson. And you've got to be steadfast when you see these bigger trends move. But the only thing is that in order to garnish your conviction, you've got to do the work. You've got to put everything together so that you're absolutely convinced there's not any glint in the armor where a knife can just wiggle in and throw you off course.
I got a great tip, Peter, and you know, I mean, teach this, because it has kept me in some trades. It's the only thing that I have it written down. So when you're about to take profits, you ask yourself, would you reverse here? And if the answer is no, you walk away and let it work.
Let it go. I mean, I've just shown I flipped a couple of our charts that we did this year on Bitcoin, and you can see that, you can see that if you've got a pattern like this, 1, 2, 1, 2, and then you've got all these little bits going on.
Yeah, I bought that pullback into February that you have labeled too. It was 78.6 back from the initial pop.
It was perfect. And when you start getting all these little things going on, and you see you got 1, 2, 1, 2, but then the next 1, 2s are compressed. They don't.
I got out on the April Fool's joke. It blew up on April Fool's.
Yeah,
right?
It came up there.
Yeah.
I mean, as soon as you get that, you know. Now, what I tend to do as a marked measure is I always extend a series of 1-2s by 1-6-1-8.
Okay.
And I try and allow the market to expand to those numbers. Now, originally, when I did that, we were getting numbers up, I think, towards this number up here. So even during this phase, and we could see this as a correction, we thought, no, this has still got lots more to do. Just keep going, because this thing will expand. And of course, I'm working in log scale, which is also a very big plus, you know, and I keep telling all of my clients and anybody else who's willing to listen.
It's interesting. You have a target near where I have some lines at 7,500 about.
Well, this was coming in at the time, a bit of congestion, and then this rally. And I'll show you the next chart after that.
Oh, okay.
And then, of course, we could see that this was getting into those numbers. I used a 60-1-8 correlative ratio. I measured 1 to 3 here, took a correlative ratio, added to 4, which finished there, and put up that 13,712 number. And then before you know it, you're there. And we got to 13.8, not 13.7, and then we saw this 25% drop. Even the rallies are sometimes working. Now, in previous years, when I looked at Bitcoin, there were lots of gaps before this IMM contract came on board, or CBOT, whatever. And there were lots of gaps. The patterns weren't running very nicely according to the Elliott process. But now they're actually working really well. And I think that's down to the fact that we've got a major exchange where it's traded. The institutions are getting involved. And I'm seeing a lot more conformity to the patterns. Here, for example, was a rally in wave X to 12.3. And within the next day, you had 12.4.
Nice.
12.3 number. You can't, there's a fingernail difference. And then suddenly, bang, we're coming down.
Right.
So the patterns are pretty good on Bitcoin. So if you are trading it, we've got some great new updates in our currency report. We're just releasing that today.
Cool. Can you wrap it with look at gold and silver?
Yeah. Let's take a look at gold. I still think that gold is going to attempt a little bit higher. I'd love 1523 to come in. I'm not sure if it's capable of doing that because of the dollar position at the moment. But it's shrugged off the dollar several times in its recent push up. And I think that if the stock market were to suddenly drop, there might just be enough people with a gold inclination at the moment to go in and buy more gold as a bit of a hedge, because people are talking about it being more of a hedge than they've ever done before in the last 2 years.
Okay.
So, but the main reason why I don't want to be around for this for too long on the upside is because there's a gold cycle, which I'll show you now. It's a daily gold cycle. And it shows that we've got a peak in about August time coming in, and then it flattens off into September, and it starts to drift off. And so I think that, you know, some of the sentiment indicators on gold are a bit high at the moment. The net speculative long positioning is a bit high. And I can see that if we did thrust somewhere anywhere towards 1500 would be a satisfactory end.
Yeah, I was thinking about 1480, 85 or something, but yeah. Okay.
Something like that, yeah.
And silver is, what's that chart in, okay, that's gold. And silver, really, I'm sure you pay attention to the gold-silver ratio. I was seeing it topping out at about in the 90s, and said one day we'll look back and go, why didn't we sell all our gold and buy silver?
Well, yeah. I mean, the gold-silver ratio historically, I mean, if you're in the 90s on the gold-silver ratio, I mean, think of it. You've got 90 silver coins laying on your table in front of you, and you've got one gold coin.
Yeah.
Now, if you throw anybody in, you know, and look at the physical coins in front of you and say, right, what do you want, one of them or 90 of those? I know what I would choose.
Right.
You know, I mean, if you had to
because the mean is like usually having 40 or 50 of them.
Well, it's not so much that. If you wanted to break that single gold coin into 90 singular pieces, how would you do it? I mean, if I want to go and buy some bread down the road, you know.
Are you an alchemist too? I mean, what a renaissance, man. So Peter, you know, every time you come, you give me clarity of you know, big picture stuff that I could use my stuff for timing your ideas, and you've really helped me make money over the years. And I'm sure everyone who listens to you, and that includes times that you're not right, because that happens too. But you're really, there's something about the way you also present your work that gives people clarity when they listen to you that they probably don't get when they just read a letter. But I know you do video series too, so this would be a great time to show your website and how people could get involved with you.
Oh, great. Thanks.
Okay, buddy. It's commercial time.
Okay. Well, if anybody's listening and they're interested in what we're doing, and we're doing quite a different look at across 4 different asset classes. I'm sure that we're looking at something that you're trading already, and our short-term updates are published twice a week in the Elliott Wave Compass reports, and you can actually go onto our website. This is wavetrack.com, and if you want to read about the Elliott Wave Compass report, click here, and you can read about it. And then if you want to order the Compass report, you can go here. So that's one way to get a really good, concise idea of some of the shorter-term trends, like Bitcoin, for example, all the current major currencies. And, of course, the stock markets, the S&P, the Dow, the Russell, and the NASDAQ, and also the European markets and some Asian markets too. Now, in the last month, we've been publishing our video series, and this is really great because these are the longer-term charts. I mean, we often get clients saying, well, okay, you're publishing the Elliott Wave Compass twice a week. We want to see the bigger picture a while to give us some perspective. Well, now's the chance to do it, because this is part 1, which we launched in June. This is stock indexes, and this is our blog. Actually, you can go back to wavetrack.com, and on the top right-hand side, you can click on the news alerts here to look at those. So this is part 1, which is stock indices. And then we have commodities, which is very extensive. I think that's probably our biggest report of the 3 out of the video series. And then you can click on the currencies report, which we're publishing today, actually. So,
wow.
This is right hot off, it's right hot off the press, July 24th, that's today. And I've written a nice introduction to the way it is. I've picked up some stuff with courtesy from Market and JP Morgan, which relates to the inflation pop and the way that the dollar's going to react from that. So if you want to order that, you can see details there too. So there's a couple of ways in which you can log into us, and we'd be happy to welcome you into our fold.
And that's www.wavetrack.com?
Certainly, this is our main website, and then you can get to the blog by clicking on any of the links over to the right.
Okay, and your Twitter handle again, Peter?
Our Twitter handle, you always ask me that, and I'm never prepared for it, am I?
Yeah, you're not that active on it. It has a hyphen in there. It's Elliott Wave _.
Well, I'm not as active as you are, but here it is.
I have to go to TA meetings, Twitter Anonymous meetings.
This is our handle. It's at Elliott Wave _WTI.
Okay.
Wave
Thank you.
So
Thank
that's
you,
how you can,
yeah. I encourage people. Peter's part of my intelligence gathering, and has helped me since I've known him, and encourage people to check it out. And want to thank you so much for coming in again, Peter, and sharing with your giving spirit of, sharing your major views, which I know you put a lot of hard work into. And may all your forecasts turn up multiple pips, like a tsunami rushing over, chasing down all your subscribers and overtaking them with riches.
Thanks, Dale, and best wishes to you and to everybody listening in. Yeah.
All right, Peter. Thank you. That's my trading warrior brother, Peter Goodburn, at Elliott Wave _WTI, and you can go to his website and check out his hot off the press currency review. I know I'm going to do it. So thanks again, Peter. Good hunting, my friend, and let's get back together in the fall, see how things are shaping up.
Adios, Dale.
Adios. So that's it for us today, guys. Hope you enjoyed. remember, don't just count your pips. Come on, man. Count your blessings too. Okay? See everyone tomorrow for Mario. So we'll see what happens tomorrow. Adios. Oh no, arrivederci. I'll see you later. All right. All right, Warriors. See ya. Oh no, I don't want to leave the meeting. I want to end the meeting. This happens when my guests leave early to me. Share participants. Can someone help me? I ended the recording.